Did you know that there is a multi-trillion-dollar possibility that might propel the shares of Tesla to rapid growth? Some people think that a Tesla stock increase is more likely than not, but bears don't think so. To learn more, keep watching and listening. Whenever Tesla is involved in a debate, even the smallest remarks frequently get carried out of hand. Nonetheless, when well-known figures are involved, some Tesla news is truly noteworthy. Discover today why this multi-trillion-dollar opportunity will cause Tesla's stock to soar. Adam Jonas, an analyst at Morgan Stanley, believes that Tesla is well positioned to access many industries with a combined value of trillions of dollars. Recall that Jonas said previously, consider the EV race as a marathon. At mile 21, Tesla is leading the field. The other competitors are either at mile 2 or are still tying their shoes. In a research note from a few years ago, Jonas stated that he believes Tesla is evolving from an electric car company to more of an infrastructure transportation firm, and that this development is critical to the company's eventual worth. Among the markets within Tesla's ecosystem that Jonas identified in the aforementioned note are as follows: a $10 trillion market for light vehicle mobility, a $1 trillion market for logistics, a $2 to $3 trillion market for energy storage, and a potentially multi-trillion-dollar market centered around the delivery of content and the monetization of data gathered during the 600 billion hours that Tesla owners spend in their vehicles. Furthermore, according to Jonas, one of Tesla's most significant assets may be its data. Although hard to measure, Jonas wrote, "We have long felt that one of Tesla's most important areas of value is its captive ecosystem of data collecting transport machines, with close proximity to data that may have any number of adjacent purposes for monetization and slash or deepening of the strategic moat." Accordingly, any advancements in electric vehicle technology, according to Jonas, provide Tesla a competitive edge in autonomous driving and in the potential car-sharing market. Even though autonomous technology can support electric vehicles and carpooling, Jonas acknowledges that there are dangers involved. According to him, Tesla might never grow into the car-sharing venture Musk has mentioned and which Jonas has partially based his investment thesis on. Instead, it might become a specialized electric vehicle manufacturer. But for good reason. Jonas is a Tesla bull, and he believes that customers may experience tantalizingly high levels of safety with Tesla's autopilot technology. Jonas stated, "Our discussions with auto companies and regulators suggest a high level of lawmaker attention to the unprecedented spike in fatalities on U.S. roads." He continued by saying that Tesla wants to build human-driven vehicles that are 10 times safer than the typical vehicle on the road. In our opinion, anything even close to this order of magnitude of safety improvement could elevate market awareness, both the financial and the consumer market of Tesla's technologies, and the need to replace and upgrade the existing stock of used cars, Jonas stated in the research note in question. Do you really believe there is a multi-trillion-dollar opportunity for Tesla and its stock? Post your ideas in the space provided for comments below. Assuming that the whole automobile industry switches to electric cars, EVs have the potential to significantly alter the way the renewable energy transport economy is designed. Many think that batteries will power the globe in the near future, so the next battery invention and the materials used in it present the biggest opportunity to benefit from the lucrative momentum of the multi-trillion-dollar energy shift. Bloomberg NEF reports that investments in the global energy transition hit a record $501.3 billion in 2020. It seems that big money is flooding the market with new energy in a way that is appropriate for a revolution. Furthermore, organizations, endowments, and foundations holding more than $14 trillion in assets are prepared to assist in the energy transition. Forbes describes it as a change in paradigm. This is a big amount of money, and one of the reasons investors are worried about legacy manufacturers is that they have a big internal combustion engine vehicle sector. With this enormous commitment, legacy automakers are trying to serve two masters: internal combustion engines and electric vehicles. They have only one client, and they will fail if it isn't an electric vehicle. Many experts and analysts concur that Tesla is the top electric vehicle, EV firm in the market on its own. Morgan Stanley says Tesla is undervalued and overvalued at the same time. They think Tesla may be significantly undervalued as an onshore infrastructure provider for renewable energy, despite being pricey as a pure vehicle company. They consider Tesla to be the best capital expenditure for batteries. Morgan Stanley predicts that two major events, war and inflation, will reward energy innovation. Given the current environment, they think that events in the upcoming 6 months will significantly affect the storyline around Tesla's operations, the markets it caters to, its rate of expansion, and the ecosystem's worldwide strategic ramifications. The advantages of Tesla's direct-to-consumer business model are also starting to be recognized by a large number of investors. Legacy automakers are unable to implement this strategy because of tight state dealer franchise laws. Rather, it eliminates the intermediary and lessens political influence, enabling the brand to provide its clients with appropriate service. According to Morgan Stanley, there are other significant factors influencing the multi-decatrillion-dollar battery capex cycle. As globalization advances into a new era characterized by heightened worries about national security, investors need to take into account the new infrastructure and energy supply. Future battery storage will be essential, and Tesla is positioned to take the lead in this area. Doubts quickly surfaced when Tesla's market valuation exceeded $1 trillion in the previous year. Prior to this, only Alphabet, Apple, Microsoft, and Amazon have reached this milestone. But Tesla is right beside them in reaching that milestone because of a $4 billion agreement to sell 100,000 cars to the rental car company Hertz. But it's important to remember that Tesla, driven by Elon Musk, operates in a completely different sector of the economy than the aforementioned massive companies. Having said that, the market capitalization of the leader in electric vehicles, which was valued at approximately $842 billion at the end of 2021, exceeded $1 trillion. Long-term investors, however, ought to pay more attention to a company's long-term trajectory and be less bothered with noise in the short term. Rather, Allied Market Research projects that the worldwide EV market will develop at a compound annual growth rate of 18.2% through 2030. This means that Tesla appears to be in a favorable position to take advantage of the expanding trend. After the market closed on July 20, Tesla released its second quarter earnings. While growth wasn't perfect, it was still in line with experts' expectations. Tesla's $16.9 billion in revenue was a 41.6% year-over-year rise, meeting Wall Street expectations. Additionally, its adjusted earnings per share increased by 56.6% to $2.27, comfortably above estimates by 27%. While both production and deliveries declined by 15.3% and 17.9% from the previous quarter, they both climbed by 25.3% and 26.5%, respectively, year over year. Due to persistent supply chain bottlenecks that have been negatively impacting the world economy for some time, as well as the COVID-related suspension of its Shanghai factory, there has been a decline in output and deliveries when compared to the first quarter. Wall Street analysts predict that Tesla will increase its top and bottom lines by 57.4% and 74.2%, respectively, for the entire fiscal year, despite the company's current issues. Those are remarkable growth rates, particularly considering that Tesla still needs to resolve a few production and supply chain concerns. S&P Market Intelligence data shows that analysts project the leading electric vehicle, EV, will produce $164 billion in total sales by 2025, representing a 5-year compound annual growth rate, CAGR, of 25.4% from last year's revenue. By 2025, the business would have an enterprise value of $2.3 trillion at an enterprise value to EBITDA multiple of 55.6, which is where Tesla trades today, assuming a 25% EBITDA margin or $41 billion in yearly EBITDA. Compared to its current enterprise value of approximately $829 billion, that is a 175% upside. If Tesla achieves an EBITDA of $41 billion by fiscal 2025, its enterprise value would reach $6.2 trillion at an enterprise value to EBITDA multiple of 15.3, which is the company's 5-year average. Since that the EV company's growth will probably slow down in the next years, it is not totally feasible that it would trade at such a high multiple in those years. However, an enterprise value estimate of $1 trillion, just 23.7% more than its current value, would result from a more cautious multiple of 25, which is still higher than the average of 17.1 for the S&P 500. For more of this kind of stuff, check out Tesla stock and our other films.